Welcome back to this Yahoo Finance special jobs report. Here's a look at how the futures are reacting to that jobs report. Rally is all the way around. Dow futures up 174, S&P futures up 18. We've got NASDAQ futures rallying 62 points on news that the economy added 266,000 jobs last month. The unemployment rate ticking down to 3.5%, and wages up 3.1% year over year. By nearly every metric, this report beat what the street was expecting.
And of course, we all want to know what this might mean for the Federal Reserve. They will have their last policy meeting of the year next week. Yahoo Finance's Brian Chung is in our newsroom with more on that. So, Brian, I think the market certainly likes this report. There was not an expectation that the Fed would move next week, but we will get new economic projections. What do you think this means for the Fed?
Well, whoa, what a big labor market report for the last month. It did have a quite impressive beat of 266,000. That did beat the consensus of 180,000. So that is well above trend for what we've seen in the past few reports, basically since the end of the summer, where the trend has been about 160,000. Some expected it to be 180,000 because of the offset from the ending of the GM strike. But what we've seen is that Fed funds futures markets were pretty much set already on the idea of there being no change to the federal funds rate. That is the benchmark interest rate in the United States in the Fed's final meeting of 2019. That will come next Wednesday. Headed into the jobs report today, the expectation on the street based on Fed funds futures contracts was actually a 99.3% chance of no change at all, with only a 0.7% chance of a hike here. And the only thing that you would see from a labor market report that would tell you or justify any case for a rate hike would be any sort of runaway inflationary pressures that you would see from wage growth, which, even though it did beat expectations, it only beat expectations by 0.1%. So not necessarily telling you based on this report, although you could call it hot, that there are runaway wage pressures, which means that the Federal Reserve's thesis for right now that they can let the economy run hot at the current level of 1.5 to 1.75% is pretty much okay for the time being. Miles?
And, Brian, we've been talking about this idea, I think you and I have talked about this, that Jay Powell is so sure that he's done the right thing, that he's, really has his hand on the right policy levers right now. I sort of wonder if you could make the argument that he would look at this report and say, actually, I should cut rates because cutting rates is so effective and helps the economy so much, and there's so much slack left that maybe I should goose this thing along. He won't do that, but you could make that argument if you wanted to.
Well, that is part of his thesis so far, saying that he's actually comfortable with having more accommodative rates than what they call the R-star, or the neutral rate of the economy, because they want the labor market to continue to run hot. Keep in mind, the Federal Reserve never expected the unemployment rate to be at 3.5%. They thought that the natural rate was somewhere, 200 basis points above that. So the Federal Reserve is comfortable with letting that run, but they don't want to provide too much accommodation. Jay Powell has said that he doesn't want to provide too much leverage to the system as well. So kind of a pushback on that point, but it seems like for right now, this seems to reinforce that rates will stay where they are for right now.